Hello, this is Jordan Zimbelman. I'm the instructor for your course this semester. This is the first time I've talked with you. I meant to make a video for the first module, but it didn't happen. So I'm going to try to do this for each module. It's just a real short overview of what you're going to do in this module. I'll try to focus on the things you need to do to get your quiz done well. Some points I'm going to touch on here. We'll start with the accounting equation, assets equals liabilities plus equity. Hopefully you've seen that before, but there's two sides to the balance sheet. The left side's all your assets, everything you own. The right side's where you got the money to buy all those assets. That's your liabilities, which are debt, or equity, which is money put in by the owners of the company. Some definitions. An account is a record on one of those three. It's either an asset account, could be like cash, or it could be long-term assets, plant, property, and equipment, something like that. An account could be a bond you issued in order to fund your company, or it could be an account like retained earnings or something in equity, which is money you've earned and didn't pay it out, but you reinvested in the company. A chart of accounts, you need to know that definition, is just a list of all the accounts that you have. So, you have assets, liability, equity, and then on the income statement you have revenues and expenses. A ledger is a recording of all the changes in these that happened over the period. This chapter starts an introduction to what we call double entry accounting, which is debits and credits, basically. There's always two accounts that get affected, at least two, there could be more, with every transaction that happens within a business. For example, if you bought inventory would go up, cash would go down, or accounts payable would go up. Something like that. So two things have to happen. You could add money to the firm by borrowing, and you're gonna increase liabilities, you're gonna increase cash. But there's always got to be two things that happen to add up, and that's where the T account system comes in. You have debits and credits. So the left side of the T account is called the debit. So it's always over here on the left. The right side is the credit for each account. There's always going to be two of those that happen. So there's going to be a debit and a credit. Your assets, when a debit happens, go up. When a credit happens, go down. Everything on the right or left-hand side of the balance sheet, that's your assets. A debit increases it and a credit decreases it. It's going to be really important that you know this on the quiz. And you know the accounts, what's an asset, what's a liability, what's equity, and you know what's a debit and what's a credit. Does the debit increase it or does the debit decrease it? Everything on the right-hand side of the balance sheet, a debit decreases the value of it and a credit increases. So it's the opposite. This is a little hard to remember at first, but if you do it enough and look at it enough, you'll learn it. So both with liabilities and equities, debits decrease, credits increase, assets, debits increase, and credits. So they're opposite. Left-hand side of the balance sheet, right-hand side of the balance sheet. A little bit bigger list of these debits and credits. Again, on the left-hand side, debit up, credit down. Everything on the right-hand side, if it increases one of the accounts, it's a credit, the opposite of over here. If it decreases one of them, I'm sorry, if it decreases, it's credit. If it increases, puts credit up. If it increases the account, it lowers it. It's a debit. So it's a little bit complicated. All we've added here is dividends and then the income statement. Those go into retained earnings. So, for example, dividends are, because there's a minus sign with dividends, it decreases retained earnings. It flips it because it's a minus sign. So a debit now is up, a credit now is down. Revenues have a positive sign to go into retained earnings, and so they're the normal way on the right-hand side of the balance sheet. Debit down, credit up. Expenses have a negative sign, and so they're like dividends. Debits up, credit down. I know this is complicated, but you need to make sure you know all these accounts for the quiz. There's a big part of the quiz is that. All right, some more definitions. Source documents are used to start the accounting process, and that's what we're going to cover here. Is kind of the order of things that happen. So you start with source documents. That's like receipts, things like that. Then you go into what's called the journal, which is just a list of what's come in off those receipts. Then that eventually gets posted. When it gets posted, it goes into each account and either debits or credits it. Eventually you end up with what's called the trial balance, and that's a list of all the debits and credits that have happened. So these are all balance sheet side things, assets on the balance sheet. So they're all on the debit side. These are on the right-hand side of the balance sheet. These are credits. And then the income statement, which basically goes into the right-hand side of the balance sheet. But the important part is all the debits have to equal all the credits, because it's double entry accounting, and that's how they check to make sure they got the numbers right. And then eventually you put them all into the financial statements. So you got your income statement over here, retained earnings, balance sheet, and that's the final step. So, all right, it's just an intro, but make sure you go through all the slides and all the information in the textbook. And good luck this semester and this module. Nice talking with you. Thank you for clicking on this video. Good day.